Welcome to Yaka Digital Network videos. Today, we are exploring agricultural finance. Why does one hardworking farmer stay at a subsistence level while another builds a commercial farming empire? Subsistence farming often relies entirely on manual labor and traditional practices, yielding just enough to feed a single household. Moving to a commercial scale, where crops are grown consistently for profit, requires investment in high-quality inputs like improved seeds, fertilizers, and modern machinery. That transition demands capital. This diagram shows the 4 pillars of agricultural finance that make that transition possible: agricultural credit, agricultural insurance, saving schemes, and agribusiness banking. Money is the practical catalyst here. It ensures farmers can procure quality inputs exactly when they are needed during the short planting season, building long-term business resilience and higher crop yields. Looking at this timeline graphic, we can see how different financial needs are met. This section highlights the 0 to 12-month window, representing short-term agricultural credit. Because agricultural production is highly seasonal, farmers use these short-term loans to cover immediate cash flow shortages for inputs like seeds, fertilizers, and labor for a single season. But the timeline expands to show a 1 to 5+ year window for long-term credit. This is necessary for major capital investments, such as purchasing additional land or constructing a milk cooling facility. Because these investments take years to become profitable, long-term financing is essential to support them. This flowchart illustrates the concept of value addition, which those long-term investments unlock. You can see raw milk entering a cooling and pasteurizing plant and exiting as high-value packaged dairy. By processing a raw product into a finished good, the farmer increases the value of their output and fetches a much higher market price. Without access to that long-term credit, a farmer cannot build this processing infrastructure. They remain economically trapped, forced to constantly sell raw, unprocessed materials for low returns. There are severe challenges when seeking credit. Many commercial banks in Uganda hesitate to provide loans to small-scale farmers. Most lack formal land titles to serve as recognized collateral, and the cost of borrowing comes with prohibitively high interest rates that eat into profit margins. Let's pause and apply this to the environment. Based on what you know about rural farming, write down 2 ways climate change makes agriculture a high-risk sector for financial institutions. First, unpredictable weather causes severe, prolonged droughts. If a bank issues a loan and the rains fail, crops die, leaving the farmer with no income and making loan defaults practically guaranteed. Second, climate extremes drive sudden flooding and increase the frequency of pest infestations and disease outbreaks. A single unexpected flood can wash away an entire season of investment overnight. From a financial institution's perspective, this combination of uncontrollable environmental risk and a lack of recognizable collateral makes the agricultural sector inherently unbankable without intervention. One direct way to overcome these hurdles is through education. Farmer field schools integrate financial training into everyday agricultural lessons. By teaching farmers how to maintain simple, accurate ledgers alongside farming techniques, they learn to calculate profit and clearly understand their cash flow. Mobile banking platforms provide another critical bridge. They bypass the physical limitations of inadequate rural infrastructure. Farmers can safely track expenses, save money, and access credit digitally without needing to travel long distances to formal banking branches. By combining accurate record-keeping with mobile savings habits, farmers steadily accumulate capital and build the documented financial history required to qualify for formal credit down the line. Let's bring all these concepts together. This summary matrix details the specific financial tools, their functions, and the Ugandan challenges they directly solve. As the first row populates, we see short and long-term credit resolve cash flow shortages for inputs. To solve the lack of collateral, farmers rely on group savings or improved financial literacy to prove their creditworthiness. The remaining rows show agricultural insurance acting as a safety net against those uncontrollable climate risks, while mobile banking provides a practical solution to geographic and infrastructural barriers. Securing credit, utilizing insurance, and practicing disciplined financial management are the mandatory steps for any farmer seeking to scale from subsistence survival into sustainable, commercial value addition. You can watch more videos for all classes here and get all content at www.yaka.cc.